Hey, everybody. Welcome to Real Life Realtor. I am excited that you're able to join me today. I got some really exciting guests. Actually, I'm invading their studio, the Capital Home Loan recording studio, and I have two fine gentlemen with me from Capital Home Loans, Kevin Robinson and Colin Kass, and we are going to be talking about lending, loans, all kinds of things, real estate related as far as financing. So
everything to put you to sleep.
I was going to say, this is the first time Colin and I have been introduced as exciting guests.
Yeah, well, you guys are exciting.
Nothing like an APR to get the blood flow.
Right.
You guys absolutely are exciting. So people are going to want to hear what you have to say about all this cool stuff. So I appreciate those tuning in today, and hopefully these guys will have some information for you that will be beneficial and informative. If you are in the real estate market, you're thinking about financing, maybe you already own your own home and you're thinking about making a purchase and selling. So thanks, guys, for coming on, man.
Thanks for having us.
Yeah. This is like your home turf, and I'm like running the board and running the show. So I feel
it's nice to be on this side of things.
Yeah. I might take a nap.
You guys just
feels good over here.
I'll put you to sleep, Kev.
Don't do that.
We know.
Like you said, let's start talking about interest rates. Let's go.
Part of the reason why I brought you guys on is because you're so funny. You know,
so first of all, I've listened to your podcast before. I didn't catch the name before. What's the name of the podcast?
Real Life Realtor.
I kind of like that.
Yeah. Well, I had to come up with some name.
Who came up with that, Jeremy?
I really did. Because there's a lot of fake realtors out there. There's a lot of social media realtors out there. I'm a real life realtor.
You are real.
I'm for real.
In the flesh, we can see you.
So
can verify.
Yeah.
And he's not wearing a tie.
Capital Home Loan Studio
tie,
verified.
No tie. I've got away from the no tie real estate guy.
That.
I mean, I like it.
I like the catchphrase.
I do too, but it never got much traction. The only person that calls me no tie anymore is Griffin Jones. Every time I see
but
that,
you were wearing a tie in your picture,
that was
so
the funny part, though.
People didn't get
that was the funny part.
The
no tie
sarcastic
real estate guy has a tie on his headshot. So,
I liked it.
Yeah, well, appreciate it. Hey, seriously, in all seriousness, thanks guys for doing this. I appreciate it. From the real estate side of it, so many times people come into me and they decide they want to purchase a house, and I ask them, hey, have you guys got your pre-approval yet, or have you been through the financing side of this? And the answer is no. And oftentimes the first-time home buyers are just literally lost. They don't understand that there's a bunch of different kinds of loans out there. They have misconceptions about what their down payment needs are and interest rates. And, a lot of times they just want to hop on a website for a commercial they see and they think they're pre-approved and they're really not. So it's important for you guys, I think, for my listeners to get a better understanding of what they really should be doing with local reputable lenders and what the process really is. So which of you wants to tell us a little bit about the types of loans, like what is out there and what are the things that are most commonly used if you're going to finance a home?
I think we both chime in on it probably, but
I just want to start. Because you mentioned something about like online and things like that. I think it's important for people, especially as we head into 25 here. You'll go on to some of these big, I guess we'll just use Rocket, and people will type in their data, they'll have their credit pulled automatically, and they get this letter, instantly. Mm-hmm. The difference is when Colin gets a pre-approval, he's pulling in their W-2s, their pay stubs, is there some variances in his pay?
Well, that's what any good lender should do.
100%.
Not just me, that's what a lot of lenders do, and that's what any good lender should be doing.
Right.
Yeah.
And I think it's just so important because a pre-approval letter these days has been kind of skewed because you might have somebody that has an approval that truly isn't been fully vetted.
Yep.
So I think that's important. But when it comes to loans, we don't see a lot of differences these days. The number one is conventional, which is the most commonly used loan out there. I think the misconception is when you hear conventional and then maybe the FHA, which we'll talk about, is that people think FHA is first-time home buyer loan, which it's not. You can do a first-time home buyer loan on a conventional product.
I actually feel like your more competitive first-time home buyer loans are conventional.
100%.
Even though I think people think the F and FHA and the FH stands for first-time home buyer.
Right.
It's actually Fair Housing Administration. But
sure.
Most of your competitive first-time home buyer programs are actually conventional loans.
Right.
Okay.
Yeah, and when he says competitive, with conventional, because when you go through that process, like we had talked about, you're going to have your credit pulled, you're going to have your income talked about, your assets, and but we're also going to look at the collateral, which is the house that you're buying. And on a conventional, they're still looking at the value of the home. They're looking at the safety and the condition of like the foundation and in the roof and things like that. But they're not as strict as some of your other products, like your FHA loan, where they're looking at peeling paint. They're looking at
handrails,
anything that's safety. I mean, small. You could have a crack in a lip on like a sidewalk block that could be called on decks that have trip hazards, things like that. So it's more competitive because it's closer to cash than any other type of loan.
Correct. However, like Kevin said, if an appraiser calls something out on a conventional loan, it's not to say that just be like, FHA, they'll want to get if there's standing water in the basement, they'll condition for it, but conventional for whatever reason, it's like, oh, it's standing water conventional. It's conventional, so you can't call for it. The appraiser can call for anything that they would deem a health or safety concern that would affect the asset of the lender. So
we talk about the FHA loan, and what is, I guess, is that typically for buyers that have lower interest or lower credit score, or the interest rate's lower? Like, what's the advantage of an FHA?
Yeah, that's a great question. Because, like you said, there's a big misconception FHA is for first-time home buyers only, and it's not. FHA, you typically see when a buyer has less than perfect credit. So maybe they have a lower credit score. FHA is also a little bit more lenient on credit seasoning requirements.
Okay.
So if a buyer had a bankruptcy, FHA is 2 years versus conventional is 4 years. So that they're a little bit more lenient on timing from the last bankruptcy. So even a buyer may have great credit, but if they filed for bankruptcy and it was discharged 2.5 years ago, they're going to have to go FHA. So typically FHA, we see when a buyer has less than perfect credit, maybe they have some fairly recent damage to the credit that they're still trying to rebuild, and they wouldn't qualify for conventional because of that. The other thing that people don't think of too, and when we pre-approve buyers, we look into this. FHA allows more seller concessions. So you may have a buyer with perfect credit, a great income, debt ratio limit, everything looks good, but maybe they're just a little bit tight on cash, and maybe they don't qualify for some of the grant programs out there. You can get the seller to pay up to 6% concessions towards their closing costs versus the 3% that conventional lending would allow. So typically, yes, I would say it's usually for people who have less than perfect credit, but there's also other reasons why someone could go FHA over conventional. Again, if you have less than perfect credit, let's just say 680, for example. 680 is not bad credit. It's also not the best.
Sure.
But a 680 credit score, you may have a better interest rate if you go FHA versus going conventional. Your PMI might be cheaper if you go FHA versus going conventional because of that 680 credit score, even though you could go conventional or FHA.
So is there PMI on conventional and FHA?
Yeah. So
okay.
FHA, you have PMI for essentially the life of the loan until you were to refinance it and get it go conventional, or until you pay it off, or sell the house, of course. Conventional lending, you have PMI for the first essentially 20% equity. So once you hit that 20% equity, that 80% loan to value mark, the PMI is removed. If you put 20% down up front, there is no PMI.
There's no PMI.
Correct.
So where's the responsibility fall to see when you hit that threshold? Is that the homeowner that says, hey, I think I have 20% equity in my house, and they reach out to you guys, and then there's appraisal done, or how does that fall off?
So there's a couple different options. If the buyer hits that 20% equity mark within the first 6 months of having their loan, so they put 5% down today, 3 months from now they sell another home that they have, and they put a huge, large principal payment down. Within the first 6 months, you can typically remove the PMI, no questions asked, just based on loan amount. If it's been more than 6 months, the lender can, not that they always do, but most of the time they will. They can ask for another appraisal. At that point, the buyer would pay for the appraisal fee. They go out, do an appraisal just to make sure that they hit that equity mark.
Okay. One of the frustrating things for me as an agent is I think the responsibility falls on the listing agent to really have conversations with their client at the listing appointment. Like, what type of financing are we going to accept? Are we going to accept conventional? Do you guys want to include FHA and VA? Because I think a lot of times listing agents are uneducated on this particular topic, and they either immediately don't offer FHA or VA as a financing type, or if I have an FHA or a VA buyer and I submit the offer as the buyer's agent, they want to act like my offer isn't equivalent to the conventional.
Sure.
Well, if you were willing to accept that as a form of financing, then why are you immediately discounting my offer as less than adequate compared to a conventional offer? What do you guys have to say about that from the lending side of it?
Yeah. So what's kind of interesting, just to go back to the early part of that statement, what's funny, and Colin, I don't know if you'll agree with me here, when we see listings out there, I think the sellers that decide to not accept VA or FHA are most of the time houses that probably could. And then we see a lot where houses go FHA that in no world or segment of our industry should those homes have ever been listed FHA.
Yep.
Okay. So it's just kind of funny. Like and VA, and we'll talk a little bit more about that as we go, because I think VA and FHA we've got to separate a little bit, because yes, they're both government, but in terms of the quality of borrower typically is a little bit different. But I think the industry, now that we're getting a little bit more inventory and things are maybe starting to open back up, are going to get further away from what you're saying, which is, okay, I've accepted FHA, but now I'm discounting that offer because it's a government. Because like Colin said, it could be someone with decent credit.
Sure.
There just might be another factor, whether it's a divorce situation where they were forced into some financial decisions that they didn't want to make. It wasn't because they weren't paying their bills. Maybe it was just because of a separation, where FHA just on a monthly basis makes more sense. So it's not necessarily because it's a bad borrower. I just had a meeting yesterday, and I used, because it was a gal that works at a car dealership, and I used this analogy. I said, FHA and conventional, when we take a borrower and we run it through our system, think of it when you go to the car dealership or somewhere to get your car fixed. And if you get just the basic, like the 3-point inspection, they're just looking at like, okay, what are your brakes? What are your, wiper fluid and your oil? Like that's it. That's an FHA loan. Like it's very basic. It's more of a broad brush. And then if you go to like a conventionals look at it more detailed. It's like that 25-point check where they're looking at, what's your credit score, your debt to income, and all those things impact. Like Colin said, your PMI on FHA is PMI. Like it's a percentage no matter what. Conventional, it can vary based on a lot of different factors, the rate, PMI, all that fun stuff. So it's just, again, it's not always just for bad and good borrowers. Just there's so many different things that we look at on conventional that sometimes an FHA makes sense just because it paints a little bit more of a broad brush.
Mm-hmm. Sure. Well, and I think from the real estate perspective, like you guys talked about, like sometimes a listing agent will immediately not have FHA or VA. So oftentimes they group those two things together, FHA and VA. And the reason for it is, I'm assuming, is they have not done their homework, whether it's going to pass the FHA or VA appraisal process, right? Mm-hmm. So talk a little bit about that. Like what, from the lending side, what is different about a FHA, VA appraisal as opposed to just a conventional appraisal?
I think, to your point, to start, I think VA and FHA get put in the same bucket, because of the appraisal guidelines. I also think for whatever reason, people think that VA also means that a borrower has damaged credit and that they can't qualify conventional. And I do, Kevin and I, we both of our favorite loans to do are veteran loans. We do a ton because we're so close to the 180th.
Sure.
And I cannot stress this enough, and Kevin can't either, and I can let him go on about the VA too. VA borrowers are generally more qualified than a conventional borrower.
Okay.
Because someone submits an offer VA, it does not mean they have bad credit. It does not mean that they have no money because they can get away with zero down. It means that they did a service to our country.
Sure.
And so the VA, it's a benefit that they have because they served our country. More often than not, like I said, those VA buyers are more qualified than any conventional buyer will ever pre-approve.
Very organized too. They're always really good borrowers. Yeah.
Now, are there bad VA borrowers occasionally? Sure, but there's also really bad conventional borrowers out there that we have to really struggle to get the thing approved too. But I can't stress that enough, and I wish I could go on national television and say that, especially to these list agents who don't want to accept a VA offer on a $400,000 house that's in immaculate condition.
Yeah.
Like these people did us a service, and it's their reward and their benefit for doing that. But I'll let you answer the question he asked.
Well, I've forgotten it because
sorry.
I got off on the.
No,
I got on my
tangent.
I got on my tangent. I
it
apologize.
No, you know how much I enjoy that.
Yeah,
So
yeah.
Sorry.
It
Jeremy.
was about the appraisal process. Like I think
yes.
sometimes the listing agent discourages their seller from taking anything other than cash or conventional because they are convinced, because they're either don't understand the process or don't want to spend the time to realize whether the house would go FHA, VA. How is that appraisal different than the conventional appraisal?
Yeah, like we talked about earlier, I mean, conventional, we're still looking at the livability of the property. So, of course, like Colin said, we do have some realtors that'll get like a huge crack in the foundation of the basement, and they're like, well, this is conventional, it doesn't matter. Well, it still matters.
Yeah.
We're financing a $400,000 property that's going to fall into the ground in 2 years.
Sure.
So there's always the big things. I think government loans are just a little bit more of a nitpick.
There's also clear guidelines and rules set into place on the where conventional it's just health or safety issues.
Yep.
FHA and VA it's no chipping paint.
Yeah, it's like a checklist
Yes.
of things
There's
they have to go through.
there's a checklist as well as if they would consider it a health or safety concern.
If anybody knows government work, I mean, the reason for that is because it's a government-backed loan, FHA and VA, even USDA. For VA, they're doing it because they're protecting the veteran. FHA, they government believes they're protecting the home buyer. Like, hey, you did an inspection, but you didn't get this fixed. We're going to make you do it. That's the reason why. Whereas conventional, like Colin had said, is more just a broad, like, hey, make sure that the foundation's good, the roof's good, windows aren't missing, things like that. Someone's not going to fall through like the second floor to the first floor. FHA, VA has that very specific. And I know, Colin, you got some good literature that you give out to your agents on this, where it literally just goes through like a checklist of, if you're a list agent and you want to offer a government loan, just look at this. I mean, black and white.
Yeah.
And if it's literally painting 3 door frames that have chipped paint, okay. I mean, I would think that makes the house look more marketable in general.
Sure.
No matter what type of financing. But, I mean, I'm not an agent, so.
Okay. Well, I appreciate that insight, because I think that kind of eliminates some of those questions that people have about the types of loans. But let's talk more about down payment needs. If I'm a buyer and I'm looking to get into the market, maybe I bought my first home and now I'm looking to upgrade, or maybe I'm a first-time home buyer. I think when I talk to people, they're all over the map in what they think they have to have for a down payment. So can you guys talk a little bit about what really somebody should be looking to have as a down payment if they're looking to either even be a first-time home buyer or upgrade to something else? Like, what are the requirements for those down payments?
Let me do it. I think sometimes the question isn't so much, what do you need for a down payment? It's how you can get that down payment. There's a majority of the loans out there that we're doing require something.
Sure.
I think the misconception is, one, you have to put 20% down. That's not true.
I hear that all the time.
Not
I
true.
hear that all the time.
That's a generational thing where,
you used to back in the day, but since then, I mean, they've conventional loans, if you're first time home buyers, again, it depends on a bunch of different factors. As low as 3% down without any, and if there's assistance programs out there where you could do less, but
no other catches, 3% down
3%.
is what you can do. Your FHA is going to be at that 3.5%. We can go further into like the concessions, like Colin had mentioned, because that does come into play with different percentages. But I think the biggest issue we come into now, and I think you probably agree, Colin, is when people have that concern, I think they know they have to have it. It's just how they can come about, that money. And some things where people think that they'll come in and be like, hey, Kevin, I don't want to like mess up my application, but the money's coming from my grandma. It's like, well, that's fine. Gifting funds is very, very common. I'd say a majority of our first-time home buyers, that's a big piece of it.
yeah.
So as long as you've got a relative, so an actual like blood relative of yours, or by marriage, you can have that money gifted, all of it, on a primary residence. So we've got people that will borrow from their 401k. It's their money. They're able to borrow from that. The big thing is if you've got that Ranger Rick that likes to put $10,000 in his mattress, you can't walk into the bank, put in $10,000 and have us use it. We do have to source it.
There's a conversation to be had about how to get that into the bank and season it properly and without raising red flags.
Right.
One of the things that drives me crazy as an agent, guys, is when somebody talks to a lender and the lender does not explain the difference to them between down payment and closing costs.
Yeah.
So I know that you guys are great about doing that, but they're two separate things, and they both can be significant amount of money.
Yep.
You know what I mean? So Tell me what kind of conversation you have with new clients to help them understand, look, there's down payment money and there's closing cost money, so they have a clear understanding of what the difference is and what that amount may be.
So the way that I explain it to people when I'm having a conversation is I say to buy a house, there's 3 buckets of money, if you will. And when you add up all 3 of those buckets, that's your cash to close. That's how much you're bringing to the table. That's how much we need to verify. And those 3 buckets are your down payment. The down payment is one of 3 buckets.
Okay.
So is that 3%? Is that 5%? Are you going VA and it's going to be 0%? That's okay. And that's a big misconception too. VA is 0% down. That's only that first bucket of down payment. Everyone still has closing costs. So your first bucket is the down payment. Your second bucket is your closing costs. Closing costs include lender fees. So every lender has their fees. They can call it a processing fee, an underwriting fee, an admin fee, a loan application fee. There's a bunch of different names that they have for it. In the end, it's a lender paid. A lender charge fee.
Okay.
That's one piece of the closing costs. You have your appraisal fee. You have credit report fees. You have flood certification fees. You have title closing costs. So title fees are on there. Those are charged by the title company. And so that bucket is your closing cost fee.
Okay.
Your closing cost bucket. And then you have your third bucket, which is your prepaids. Your prepaids bucket is your prepaid interest. So everyone has to pay interest. Essentially, if you close on the 15th of the month, you're paying prepaid interest from the 15th through the end of the month. You have your escrow set up. Typically, it's 3 months of taxes, 3 months of insurance. And then you have to pay your first year of homeowner's insurance up front. So those 3 buckets, your down payment, your closing costs, and your prepaids, equals your cash to close. That's how I know, Kevin, we all kind of explain it similarly, but that's kind of how I explain it so people know that it's not just a down payment. And then when people say, I want to put 20 grand down, I always ask them, do you want that 20 grand down plus closing costs, or do you want it to be as close to 20 grand out the door as I can get you? Mm-hmm. Most of the time they say, I want it to be as close to 20 grand out the door. So we've got to do some reverse math and figure that out. It's not very difficult, but we can do that to where they're putting down the right amount to get as close to 20 grand out the door.
And what's smart, Jeremy, about what Colin's talking about with the 3 instead of 2, down payment and closing cost in one bucket, is that a lot of people, man, your closing cost is so high. Why do you have $6,000 in cost? It's like, well, no, there's 2 different, one's a fee, one's a cost of buying the home, and one is cost of owning the home. Homeowners insurance is not a closing cost. That's a cost of ownership. So it's smart the way that you do that. I know majority of us do here at Capital, because it explains to the customer that, it's not cost. It's, that prepaid item, it's your cost of ownership, which is very, very different.
I also think it's important to note that consumers in general, they don't buy houses every day, so they don't know. They think, I need to ask the lender what the closing costs are, and we give them a number. And they compare that number to other lenders or whatever the case may be. And the one thing to note that I think is very important is unless the lender is charging astronomical points that they're not telling you about, the lender portion of the closing cost is so minimal in the grand scheme of everything you pay to buy the house. So realistically, today, the average home, somewhere when I say average, I mean in the range of probably $175,000 to $300,000. You're probably somewhere in the $7,000 range for closing costs and prepaids. At least at Capital, your lender fee is $1,000 of that.
Okay.
So the other $6,000 is appraisal, title, homeowners insurance. That's all third party that us lenders have zero control over. And so that's all going to be the same in the end no matter what. But it's those lender fees are what's going to differentiate one lender from another. And it's so minimal, but they just don't understand that, which is fine. Again, the average consumer doesn't buy a house every day. But lenders have very, very little control over what the total cost of fees is.
Well, I love that you explain it that way because it paints the picture for them. And I'm sure that there's probably times where if they talk to a different lender, they just find out what the closing cost is and they don't find out what the prepaid and the acquisition fees are and the prepaid taxes and insurance. And then they probably say, well, I talked to Capital and they said it was 6, but I talked to this person, they said it was only 2. Well, they didn't get they're not comparing apples to apples when it comes to those numbers. So I think it's a great way to explain it so they really understand it. Because as an agent, there's nothing more frustrating to me if I am talking to somebody and they're like, when we're filling out the purchase agreement, and I'm like, have you talked to your lender? Do you need any closing cost assistance? And they say, well, I have my down payment. Mm-hmm. Well, did you talk to them about your closing cost? Well, they never said anything about my closing cost.
It happens
and I'm
all
like,
the time.
how can you as a lender not have that conversation? That's like you said, if you're talking about $7,000, that's a big chunk of money. We're not talking about $1,200.
And those don't fluctuate that much. I mean, if you're buying, like I said, if you're buying a house for $150 or you're buying a house for $300, it doesn't vary based on the purchase price that much.
Because your insurance is going to be pretty similar. Your taxes are going to be similar.
Comparable,
And we're looking at everything. I mean, in this day and age too, we're looking at compensation on the real estate side. Is that negotiated in? If they've got a exclusive buyer agreement, we've got to factor that as well. Some lenders won't do that. I know, Colin, you'll probably agree. I love it when we get people that come to us. They're like, hey, so-and-so realtor said I have to come to you because my closing costs were $10,000 at my online lender, because they don't know about the simultaneous policy or a tax proration. They just say, hey, here's your cost.
Yeah.
We love that because that's an easy win.
Yeah.
It happens all the time.
Yeah.
Great. Well, one of the things that obviously a huge buzzword in the real estate world that we talk about all the time, and you guys do too, and I'm sure you're tired of talking about it, but for those out there, is interest rates. Everybody wants to know, what's the interest rate? What's the rate? What's the rate today? What's the rate tomorrow? What's the rate last week? Are they going up? Are they going down?
Yep.
And oftentimes we hear this, well, I'm just going to wait. I'm going to wait till the interest rates come down. And I've had conversations with both of you guys about this before.
Yeah.
The interest rates when they were down in the 3s, or I don't know what they bottomed out at, that's never happening again. That was like a perfect storm of a million different things all coming together at once. So I like and I've heard you guys talk about this strategy before. If you want the house, buy the house. If the rates go down, we'll refinance it when the rates go down and it makes sense. And I like your guys' approach. There is a threshold of when it makes sense. It doesn't make sense if they go down 0.25% or 0.5%. No. Like, if you're going to be in this home for a long period of time, let's figure out where the rate goes, where it makes sense. So what kind of conversation do you guys have when you get that call? Hey, what's your rates? Or you see somebody in the street that talks about rates. What are you guys telling them?
Well, speaking of exciting, guys.
This is going to put you.
Yeah. I do a market update on Mondays and Fridays that will really get your blood boiling.
Yeah. When I talk to somebody, I make it. I will quote anyone a rate. I mean, that's part of our job is to quote a rate, but it's also to educate. So when someone calls me with that, which happens often, especially now that rates have gone up from the 3%, like you said, that they were at, I will quote the rate, and I kind of go over why they are where they are. I mean, during COVID, rates did dip into the 3s, like you said. I mean, they plateaued probably in the high 2s. But what was happening, and people don't realize this, is the Fed was pumping money into the bond market, artificially driving these interest rates down, because we had a global pandemic that we had never had before.
And nobody's prepared for it. Nobody knows what to do.
No one knows how to handle it. No matter what side of politics you're on, this was not a political thing. It was very much a how the heck do we handle something like this? Nobody knew. So that was one thing the Fed was doing to try and help. And then, a year and a half later, they reanalyzed everything and said, okay, we don't need to pump all this money in the bond market anymore. And they shut that. It wasn't a gradual shut off. They turned that fire hose off completely immediately. And within a month, rates were going up and up and up to where they should have been. Based on where inflation was, that's where rates should have been the entire time. We never will see those rates again. And I explain this to people, how rates got where they were, because people that are in their 50s, they knew people that are in their 40s knew what rates were pre-COVID. And they knew what rates were probably 10 years prior to that, which is about where they're at now, not too far off.
Yeah.
So I explain that. I explain that rates are not going to get back to where they were. And if it does, it's not a good thing. When rates get that low, it means
it was terrible.
It was a global catastrophe that we had.
People thought that it was a good thing because the rates were so low, but what they weren't understanding was the prices of homes were going up, and people were losing their minds because in order to be competitive, they had to do appraisal gaps, and they had to do escalation clauses, and they had to waive inspections, and they were doing these wild, crazy things.
People were throwing insane amounts of money at.
I'm sure you guys saw people drawing money out of retirement funds.
Yeah.
And
anywhere
insane.
they could find it.
Anywhere they could find it. It was wild.
So they were suckered in by the low rate, but yet they were making terrible decisions everywhere else in the process.
Yeah, it was crazy. And we have seen that slow down quite a bit since then, which is good. I mean, the other thing I tell people too is as we're going over the rates, no matter where they're at, they've been very volatile this last couple of years, and they probably will be. The Fed has said that rates are going to come down, but it's not going to be a smooth ride. We're not going to go from 7% today to 6.5 next month, and it's going to just like plateau smoothly. I mean, 2 months ago for like a week, we hit 6%, 5.9, 6%. And then there was some economic data that came out and it shot them right back up to 7.25. And so it's going to be a very rocky road to get down. And I tell people, this is what the payment looks like in your budget and your price point. If it's within your comfort zone, just take it. The rate doesn't mean that much. It does to an extent, but it doesn't, because when you lock in a fixed interest rate, that I tell people, I can guarantee you this is the highest your rate will get, and this is the highest your loan payment will ever get. Your payment will never go up. You buy the house for $250, you got the house for $250, it's yours. Mm-hmm. You're paying 7% interest rate, your payment's $1,500 a month. That's your payment. It's not going to go up. If you wait a year to buy that $250,000 house, now it might be worth $275,000. If you're in Perrysburg, it could be worth $350,000 by then. Who knows?
Sure.
And rates could still be the same a year from now. We don't know that if and when they're going to come down. So I always kind of have that conversation with people. I educate them and just let them know how COVID happened, why the rates were crazy like they were. Let them know if they can afford the payment, take the payment. Don't focus on the rate as much, because there's that cheesy saying, marry the house, date the rate. The rates are temporary until they do come down. If and when that happens, we'll refinance you and it actually makes sense. But I can promise you your mortgage payment will not get higher than it is right now.
Yeah, I agree with that. That's great advice for people out there. One of the last things I want to talk to you guys about is the Toledo area has shown up in numerous places as one of the top 10 places to invest in real estate for investing purposes, because our price point, relatively speaking, to the towards the coast, like the East Coast, Florida, West Coast. I mean, the purchase price is insane, and then because we have a little bit of an inventory problem, the inventory problem trickles down to inventory of rentals. So it's pretty easy to get a rental. You don't have to expect a lot of vacancies. The rate that you're going to get, or the rent you're going to get, typically tends to be pretty high, relatively speaking, to the purchase point. So the cash flow. So we have a lot of people that like investing in Northwest Ohio. What are your guys' requirements for investors looking to get financed compared to a primary residence? Like what does somebody need to do if they want to be an investor?
Good question. I mean, there's a couple different ways to go about it. And I know Colin and I know quite a bit about this because we're investors ourselves. And I mean, Toledo is a great place to buy and invest in the market. But I think the big difference is the down payment. We're now looking conventional only. It does lock up some of the other options there. So you've either got conventional, or we could probably do a whole podcast on some of the other like DCSR loans and things like that. But if you're looking straight conventional, the big difference is if it's a house, we're looking at 20% down. You can go as low as 15. I don't think we've ever written a 15% down investment loan. It just seems silly. And then if you do a multifamily, it's 25% down.
Okay.
And then like we talked about with some of those tiers and pricing, investment properties, I mean, they have made them more expensive because they are more risk-based properties. It's not like a house that you're living in. It's the first bill that we pay every month, probably, is your mortgage payment. If it's an investment property, it's your second home or an investment.
So by more expensive, you're saying the rates are typically
the rates are higher.
Okay.
Rates are usually higher. A lot of times, depending on how much you're putting down, there's points involved with it too. 1 to 2 points typically we see.
Expenses are a little bit higher.
Yeah.
One of the questions I get a lot of times, can the rental income be used when you're considering all factors, whether they can finance it? So if I'm on the cusp of maybe I'm going to get pre-approved, maybe I'm not, but this is an income-generating property of $1,600 a month. Does that $1,600 come into play at all?
So there's two answers to that. So the income, no, but you can use the revenue. So what we typically do, so I'll use we have a lot of let's say a school teacher that want to get approved. They don't make a ton of money, but they want to buy a rental property. We can say in your scenario, let's say we have one that's $1,000 rental, mortgage payment, but it's rented at $1,600. Well, that's more than enough to cover the mortgage. For them, on paper, it's like nothing happened to their debt to income ratio. We're evening it out. Now, if you want to move to an investor that owns a portfolio and wants to use the actual income, that's a whole different conversation on what the requirements are for tax returns and things like that. But if we've got somebody that's looking to buy that's right on the cusp of being approved, as long as we can show that there's that possibility of rent above and beyond what that expense is, then yeah, we can use that to offset.
You'd use, when you order the appraisal, you order what's called a rent schedule along with it.
Okay.
They'll send that back, and you can use 75% of that to negate the payment. Like Kevin said, not use it as income, but to negate the payment from the debt ratio, like it was never there type of thing.
Yeah, it's like an appraisal of the value, but also then the appraisers going out there and pulling actual comparable rentals in the area and saying, okay, this is rented for X amount, and then they average it out just like the value.
Great. Does it matter if it's vacant? Do they just use what the market rate is, or do you have to show proof of rental history?
No, so the comparables will be other properties. It won't be the subject. Of course, if there's tenants inside the unit, they can use that. Okay. But they'll go get, like, let's say it's a duplex, they'll go find 2, 3, 4 other duplexes in the area, pull the rent from those, and use those as the average for rent.
Great.
Which in Toledo is not hard because we do have a pretty nice rental market.
Yeah, very much.
Well, as we're wrapping this up, guys, what are you looking for in 2025 from a lending perspective? What are you excited about? What are you expecting to happen?
No one has a crystal ball here. I wish we did, but we obviously have a new administration coming in to the White House. That can always change things. Hopefully for the better. I do think that the new administration, from everything I've read, they do have housing on kind of one of their top priorities, to whether it's help with interest rates, whatever the case may be. So I'm hoping that it's not. I'm hoping it's not like a rocky transition with that. If it's not, I think it'll be really good. I do think rates eventually will come down. It would be nice this year. I think the Fannie Mae and Freddie Mac report was saying that their anticipation is by the end of this year, they think rates will be back in the sixes, like low sixes, like
mid sixes.
Yeah. So if that's the case, I mean that's going to be great. If they plateau in the mid to low sixes, that's going to be huge. It does seem like while housing values are still increasing, they're not increasing at the 15, 20, 30% that they were 3-4 years ago.
It's definitely slowed down.
And I do think that they're not going to go down. I don't think home values are going to decrease by any stretch of the means. But I do think that by them not increasing so much, it'll help with affordability, plus interest rates going down. I think it's going to be a good year for real estate, personally.
Kevin?
Yeah, I 100% agree. I think a little bit of normalcy. I think we had Kevin Warren on our podcast a couple months ago, and he was talking about just the last couple of years we've had changes in how the real estate industry goes. Obviously, lending's had changes, the rate market. I think this year with, sidebar of the inauguration coming up in the transition of power, I think we might have some normalcy. I think we might have, like you said, I think the affordability will help maybe push more inventory out there, which is then going to, make the market a little bit heavier, and you sprinkle in some refis if we can kind of settle in the sixes. And I think that's where, we started out 2 years ago predicting we might be back in the fives pretty quick. I wouldn't be shocked if we hit like low sixes, and that's just it. That's where we just normalize out.
Yeah.
And I think Colin and I agree. We love it when the rates are low because it's good for business, but we love when rates are consistent.
No, if they plateau, even if they plateau at 7% for the next 5 years,
just give me a rate.
That's when, that's when life is so much easier for everybody. The volatility we've had this last couple of years has just caused chaos and any lender will agree, I think. It just causes chaos in certain ways.
Yep.
Oh, I'm with you guys. I'm ready for 2025 to be normal. I got licensed in 2017, and it seems like ever since I've been licensed, there's been chaos.
Maybe you're the problem.
It was normal in 2016.
Yeah. It was 2017. I was just figuring out how to do this job, and then the pandemic hit, and then ever since then, it's just been this wild ride.
Wild.
So I'm ready for 2025 to be normal.
Yeah.
So, well, I appreciate you guys coming on. This was great.
Yeah, thanks for having us, man.
It was a lot of great information. I think the listeners will find it very informative because there are a lot of questions out there, and sometimes people are afraid to ask or they don't know what to ask, and hopefully people will gather something from this that's going to help them through the home buying process. So appreciate you guys letting me invade your studio here.
Anytime.
Anytime,
again,
please.
We've got Kevin Robinson and Colin Kass from Capital Home Loans. If you need to do anything with real estate lending or financing, these are definitely the guys that you want to reach out to. How do they reach you guys?
You can go to our website at mycapitalhomeloans.com. I think the rest of our contact information's on there.
It's all on the website, yeah.
All right, great. And I will I'll attach it to this podcast as well. So thank you so much, guys. I appreciate it. Jeremy Wolf from Danbury Realtors. The Real Life Realtor episode is coming to an end. Thank you, guys. I appreciate it.
Thank you.